All right, so if you bought a house between 2019 and 2021, chances are your mortgage term will be up for renewal sometime in 2024 or 25. But what does this really mean for your personal finances? Well, if you remember the crazy housing market during the early pandemic, you'll remember that despite certain properties, selling for hundreds of thousands of dollars above their list price in an all-out bidding war, interest rates were really low for the better part of 2 years, meaning many borrowers locked in fixed interest rates in the waters of 1.5 to 2% over a 3 to 5 year term, which was unbelievable. To put this into perspective, a homeowner who bought a $500,000 home with 20% down at a 1.8% interest rate over 5 years, those were actual real terms, by the way, for many lenders. Well, these individuals had monthly mortgage payments of $1,650, of which around $1,050 per month is principal paydown, so equity being built in the property. And this has been the opportunity of a lifetime for many new homeowners over that period. But the problem is that this isn't the United States, where you can lock in a fixed rate for 15 or 30 years. In Canada, mortgage terms are generally, again, 3 to 5 years, meaning these same loans that we just spoke about are now coming to term, and the low interest rate party's over, where borrowers will be forced to renew at interest rates roughly 2 to 3 times higher in some cases, which will have a major impact on the monthly budgets of millions of households across Canada. In fact, according to RBC, there are over $900 billion worth of Canadian mortgages renewing from 2024 through to 2026, including my own and maybe even including yours if you're watching this video. And in parallel to this data, with 60% of Canadian mortgages set to come up for renewal within the next 3 years, most homeowners are about to face a payment shock unless interest rates come back down in a significant way. And to make matters worse, according to the Bank of Canada, as of November 2022, so over a year ago already, of the borrowers with a variable rate fixed payment mortgage, roughly 50% of them, or 13% of all Canadian mortgages combined, have already reached what's known as their trigger rate, which essentially means that for the borrowers that took out a variable rate mortgage over the past 3 to 5 years, as the interest rates have climbed over the past 24 months, more than half of these borrowers saw their monthly payments account for 0% principal paydown, and even saw their mortgage balances start to increase because those fixed mortgage payments were not enough to cover the entirety of the interest paid on the loan. So that extra interest is added to the principal balance of the mortgage loan. And although what I'm about to say may very well age poorly because the Bank of Canada changes their stance on interest rates every month, the latest information we have at our disposal indicates that they are willing to keep interest rates flat for the foreseeable future, but I think we'll start seeing rates start to gradually decrease by mid-2024. I hope. All right, so with the doom and gloom out of the way, the reality is that although mortgage renewals will be difficult for almost everyone, it's important to understand how they work if this is the first time that you actually end up going through this process if you're a new homeowner. So a mortgage renewal refers to the process in which a borrower, renews or extends their existing mortgage loan after the initial term expires. And this is because when you first take out a mortgage, it typically comes with a fixed term, commonly ranging from 1 up to 5 years in Canada. And at the end of this term, you have the option to either pay off the remaining balance, refinance the mortgage with the current lender or a new lender, or renew the mortgage for another term in the, say, 25-year total amortization. So if initially you took out a 25-year amortization, after 5 years, it would then be over another 20 years left over on that that loan to be paid off. And by the way, generally the simplest method here is just renewing with the current mortgage provider you have, although this eliminates the ability to shop around and maybe get a better interest rate on the new 3 to 5 year term that you'll be setting out for your mortgage. Now, it's important to understand that during a mortgage renewal, the lender will offer you a new interest rate that reflects the current going rates in the market, which is why millions are loathing the upcoming renewals where interest rates have jumped dramatically up from a couple years ago, thus impacting monthly payments, in this case, mostly on the rise. Side note here, I always recommend speaking with a mortgage broker as they have access to, first of all of the best rates across most lenders available in the market. And this really just makes the entire selection process more informed and data driven. Let's now take a look at some examples covering what your mortgage renewal will look like depending on your situation. Okay, so for the first example, we'll consider that you bought a house for $500,000 with 20% down at 1.8% interest with a 5-year term over 25 years. Well, after the 5-year term is up, let's say in 24 or 25, your $400,000 initial mortgage will have been paid down in this case to roughly $334,000 because from each of your $1,650 monthly payments, over $1,050 was going towards principal paydown, equity for you. And it's on this new mortgage balance that the renewal will take effect. So if opting for a straight renewal and not looking to take out any equity in the property through, say, maybe refinancing it, well, you now need a new mortgage loan for the amount of $334,000 at prevailing interest rates, which let's say is at 5% when your loan is up for renewal. Well, now, even on a mortgage balance that's $65,000 less than 5 years prior, you're looking at monthly payments of $2,200, of which only $800 is principal paydown. And this is because that $334,000 would now be paid over a 20-year period, down from 25 years initially, if you want to maintain a 25-year period to pay down the entirety of the loan. That's how it works. So what this means is that your true cost of owning the home will now increase by roughly $800 per month because your monthly payment increased by $550 and your principal paydown, so your equity, decreased by $250. But honestly, this is one of the better situations to be in compared to many homeowners who either locked in variable rate mortgages or fixed rate mortgages in the 5 to 6% range. In fact, let's take a look at a scenario like this right now. Okay, so like mentioned earlier in the video, 50% of variable rate mortgages have already exceeded their trigger rate, which means that for every fixed payment made towards the mortgage loan on a monthly basis, there's negative equity being built on the loan, which means the loan increases as the payments aren't enough to cover all of the interest required, which is super depressing for people in this situation because of a, say, $3,000 monthly payment, no equity is being built. And when renewing the loan after the term ends, the new monthly payments are on a higher mortgage balance. And this is how this may look in practice. So again, we'll consider a house purchased for $500,000 with 20% down, so a $400,000 initial loan. But in this case, a variable rate loan that was signed at, say, 1.5% in the bottom of the interest rate cycle, so fixed monthly payments of roughly $1,700 is what that would have looked like. Well, as interest rates rose though over the next 24-month period, as they have, to say 6%, well, this loan will have quickly surpassed its trigger rate, which would have been in the range of around 4.5%, meaning from then on out, each monthly payment was 100% dedicated to interest, and the principal started increasing on the loan, meaning the equity is being eroded away in the property. And side note here, combining negative payments in this case with also the price of the property itself decreasing if, say, bought at the top of the market, well, this is about the worst situation that you could find yourself in, where the value of the home decreases to be at par with what's owed owed on it or even worse. So as a result though, it's really hard to calculate exactly how much the principal would have climbed to, but on the $400,000 mortgage, it would most likely be sitting at $410,000 to $420,000 upon renewal after 5 years. So not only has the true cost of owning the home been astronomical due to interest payments, but when renewing the loan, monthly mortgage payments will be even higher. And for sake of example, let's say this individual chooses to lock in a 5-year fixed rate upon renewing the $420,000 loan at this point at 5%. Well, the monthly payments would now be $2,450 per month, and even still, only $700 is principal. And that's if renewing for another 25 years rather than even 20 years. So extending the loan again by another 5 years even. I really wish this scenario was more of an outcast, but it's unfortunately the reality that hundreds of thousands of borrowers are about to be faced with over the next couple of years. And unfortunately, there isn't a perfect game plan that applies to everyone, but I wanted to highlight a couple of things that could be considered when approaching your renewal over the next few years. So first of all, I thought I'd mention the fact that the federal government just introduced a Canadian mortgage charter on November 21st as part of its fall economic statement, where the charter recommends eliminating stress tests for insured mortgage renewals with a new lender. So let's say you're with TD and want to shop around and go to Scotiabank or Desjardins. Well, this is going to eliminate the added stress test when switching providers. Otherwise, you would pretty much be forced to stay with that initial lender and therefore not be able to really have any leverage on negotiating rates. Additionally, it's difficult to estimate where rates will even be in 2024, as fixed mortgage rates are determined by bond market activity, which can be unpredictable, and variable rate mortgages will only dip when the Bank of Canada lowers its overnight rate. But rates are definitely expected to trend lower next year, as slowing inflation and other signs of economic stability should very well help make that happen. But finding a rate significantly below 5% could still be quite challenging in 2024. So with this in mind, let's talk about 3 approaches to better your chances of securing a more favorable deal during your mortgage renewal process. So number 1, consider exploring different lenders before renewing your mortgage. Now, while renewing with your current lender is definitely convenient, they'll often just send you a letter with an offer. Well, comparing offers from other lenders might lead to significant savings, even if you're able to shave off 1 or 2 percentage decimals on your loan. This could account to thousands of dollars a year. And although switching lenders in 2024 might not involve any additional stress tests, as I just spoke about, qualifying for the new mortgage is still necessary. So enhancing your household's cash flow and reducing debt in the interim could persuade lenders to provide a more favorable loan. The second thing to consider here is that achieving a more cost-effective mortgage in the first place involves making usually a substantial down payment and therefore borrowing less, right? If you put more down on the home to begin with, your monthly payments will be lower. Well, the same principle applies to a mortgage renewal. So if possible, prioritizing paying down a significant portion of your mortgage at the better rate that you might have in place right now before negotiating your next contract could be a good course of action, right? If you currently have a mortgage at a 2% rate and know that your upcoming rate will probably be, let's say, 5 or 5.5%, it could very well make sense to pay down a portion of your balance right now, if possible, to reduce your upcoming payments and interest upon renewal, because your actual mortgage balance, the principal that is, will be lower. So to this light, many lenders do permit prepayments within specified limits, either through increased monthly payments or even lump sum contributions. So if your mortgage agreement includes this option and you have available funds to do so, a prepayment or two could contribute to a more manageable renewal process. Definitely look into this if you currently have a mortgage loan below 3%, and if you don't even know if you're able to do so without incurring any penalties, just call up your mortgage lender and get that information. Next up, we have considering extending your mortgage once again, as I spoke about earlier. So if you were on, say, a 25-year total amortization, well, instead of renewing it over 20 years, which would effectively make the entire payment period be 25 years, right? If you had a 5-year term, well, renewing it again for 25 years, once again, could also reduce payments. Now, while extending your amortization period at mortgage renewal can provide short-term relief, though, with smaller monthly payments, it does possess longer-term risks to take into account, where re-amortizing does result in extra years of additional interest charges and can potentially impact your financial future, especially if it affects your retirement plan. So definitely consider all of these factors before making that decision. So effectively, longer time to pay off the loan, but lower monthly payments in the short term. That being said, to mitigate extra interest costs, some people choose to opt to extend amortization for maybe one term and then revert to the original length later on down the line when and if they're in a better financial situation or if interest rates have lowered. Additionally, one thing you could consider is to opt for, say, a 1-year loan term instead of 3 or 5 years locked in to see where rates end up after 12 months, which may very well be lower than they are today, but that's just speculation. So is your mortgage term up for renewal over the next 12 to 24 months? Let me know down in the comments what you're planning on doing. Thanks a lot for watching today's video. If you enjoyed it, please take a second to drop a like, comment down below, subscribe to the channel, and hit the bell for more videos like this.